Welcome everyone, I'm Andrea, your automated trader. If you like what I do, don't forget to subscribe to the channel and leave a like on my videos. Today I'm making a video that probably won't interest anyone. It's a video that's a bit different from usual. It's not a motivational video, it's not a vlog. This is a video where we're going to apply some advanced statistical concepts to our portfolio. Maybe only a few people will watch this video, maybe no one will understand it. I hope that one day the right person will see this video. The right person who speaks my language and can understand what I'm doing to my portfolio. Here we are. So let's start from the beginning. We have this table that we created, just like last time with Quant Analyzer, where we have all the trades from the period we're going to analyze. In this case, I considered the 4 years of testing, of backtesting, plus almost 1 year of out-of-sample data. So basically we have all our trades and subsequently having the trades and the percentage loss or gain of each operation. I went ahead and put them together to create my compounded equity in this column. So this shows how the account would have grown using all my 32 experts that I'm currently using. The next step was to calculate the drawdown. So I have each trade, I have my drawdown. When it's 0, obviously I have no drawdown because I'm reaching a new high. From here, I'll keep it brief. I won't go into all the details. If you're interested, let me know and I'll explain how I calculated everything, all the different formulas. But for now, I'll go a bit faster. So if you want to know more, let me know in the comments. We did a whole series of calculations on the drawdown. And we went on to calculate the distribution, let's say, of the drawdowns. So the ones we had over the overall period. Let's say both in sample and out of sample, we had a maximum drawdown of 23% and 20% in the out of sample period alone. And then we tried to estimate how these drawdowns could increase if we had a normal distribution of drawdowns, but I can already tell you that's not our case because drawdowns do not follow a normal distribution. So this first approximation we made, calculating the standard deviations to estimate a future case of a larger drawdown than what we saw in the tests, did not work out. We got some numbers, but these numbers are not significant. Here we can see that, in any case, the worst day at this point is only about 10% more than before, because some changes were made to the portfolio's risk, while the best day still remains at 30%. So, we always maintain that 1-to-3 ratio between loss and gain. Here you also have all the other values related to the portfolio that I explained in the previous video. So what exactly did I do in intricate detail at this particular point? At this precise point, I diligently tried to understand what the comprehensive distribution of my financial drawdowns was in order to accurately estimate what its potential magnitude could truly be, a significant value that I could potentially reach in truly exceptional cases, so certainly not one that I will definitively reach, but rather one that I might conceivably reach. So as I was saying, the first thing I realized is that the distribution is absolutely not normal because the distribution we have is actually better than a normal one. In fact, with drawdowns, we have a lot of small drawdowns, few large drawdowns, an average drawdown depth of 4.5%, and a drawdown volatility of 3.8%, which is the standard deviation. Basically, when the portfolio goes down, it drops only a little, but when it goes up, it rises a lot and does so effortlessly. So first of all, I calculated how many. First, I removed the zeros from the drawdowns because I wasn't interested in keeping the zeros in the statistics since they would mess things up for me. The distribution, because 0 is basically not a drawdown. And when I reach a new high, so I have 16,875 drawdown values in these trades. These are all the ones that created a drawdown. I calculated the standard deviation, the mean, the skewness, and the kurtosis. Then, as we can see below, there are some charts. I went ahead and made various QQ plots compared to the normal distribution, and I examined them. Obviously, as we can see here, our drawdown distribution does not follow the normal distribution. I then tried the Lognormal as well, but again, the trend does not represent our data population. However, with the Weibull and Gamma distributions, these two approximate our drawdown distribution quite well, because our drawdowns generally follow these distributions more or less. So this helped us a lot because from here we were able to estimate what the maximum drawdown we might have in the future could be. And we can see it here. So we calculated a probability of 99.9% that this will occur, meaning we only have a 0.1% chance that this drawdown will happen in future trades. About 20,000 trades, which corresponds to what we do in 5 to 6 years. With Weibull, we have a maximum drawdown of 68%, while with the other method, we have 58%. It's clear that these are very high drawdown values, but they're also values that will occur with a very low probability. As a first approach, I also calculated the maximum drawdown using factors relative to the drawdown I experienced during my testing period and of auto-sepal. So usually here, values ranging from 1.5 up to 3 are used. And let's see what. In any case, it's a range of values that also includes the two values we calculated using statistical distributions. Then I meticulously took another deliberate step and carefully calculated using a comprehensive Monte Carlo analysis precisely what potential drawdown values I might realistically reach in various scenarios. So in this case, I performed the Monte Carlo analysis on the non-compounded equity because I had to use a program that didn't allow for equity compounding. Let's say that the non-compounded equity had an initial drawdown of 10%, and in the case of the Monte Carlo analysis, at 100%, I reached 31%, so a factor of 3 times larger. And again, this falls within the range of data we've observed because the threefold value was something we had already calculated empirically, so we're still within that range. So how do we sum up all these calculations we've done? The point is that with the level of risk we're using and with the experts we're employing in our portfolio, based on these statistical calculations, we are never able to obtain a combination that leads our portfolio to collapse. We may have very large drawdowns, possible in particular situations, but we never have a case where we collapse. So this was basically what I needed to verify. From these numbers, we can understand something fundamental for our portfolio. In none of the cases predicted by statistics, do we have drawdowns that would wipe out the account? Because after all, yes. We have a 68%, 69%, 70% maximum drawdown. In exceptional cases, we could reach it, but not beyond that. So we are quite resistant in the sense that we will have this drawdown huge. But then the portfolio will probably recover and recoup its losses over a period of time, but it will make it and recover. The last thing we still need to consider is that in the portfolio, we always use a stop based on our balance. So I always use a percentage of what's in the account, and this gives me a sort of even effect. It drops because if I end up, I don't know, losing 50% of the account, the trades are still halved. Because if I always risk 1%, when I've lost 50%, it'll still be 1%, but of half the account. And so this helps me further reduce my drawdowns. Obviously, I couldn't take this into account in the models because these are models that work on probability, so I don't know the distribution. I can't recalculate the trades while I'm building the models. So basically, I tried to stress the portfolio in every possible way I knew mathematically, but in the end, the portfolio bent, it twisted. But it always reacted and never broke. And that's exactly what I wanted. To verify that it's what I need, what gives me peace of mind to use all of this in real trading. Now I want to tell you something about my portfolio. In my opinion, my portfolio is a living portfolio that has its own natural cycle. So it has cycles that are recurring. Sometimes it grows, sometimes it struggles, sometimes it accelerates a lot, sometimes it slows down, because it's as if it were a living organism. It's not just a sequence of trades. And precisely because it has this characteristic, it should never be touched. So you shouldn't intervene anymore. You shouldn't do anything. You have to let time take its course. Because the more we change the parameters, the more we destroy all the statistical work we've done. Basically, if we intervene and make changes along the way, it's as if we ourselves are killing our portfolio. We're the ones doing it. It won't even be the market doing it anymore. In that case, it will be us who destroyed it because we changed it. And so we're no longer respecting the statistics behind it. After all these years of work with advanced mathematics and high-level statistics, the conclusion is actually very simple. You shouldn't touch anything. So we've reached the point where all that's left is to monitor what happens. If you enjoyed this video, don't forget to leave a like, subscribe to the channel, and stay tuned so you don't miss the next content I'll be publishing.